Japan just sold US Treasury bonds worth $23 billion in a single month. The Bank of Japan's balance sheet is shrinking for the first time since 2012. The yen hit a 34-year low against the dollar. Japanese 30-year bond yields broke through levels not seen since 1999. And here's the thing that should make you pay attention. Japan holds over $1 trillion of US debt. That's not their problem. That's about to become your problem. Because when the world's fourth largest economy has to start liquidating $1 trillion in treasuries to keep its own lights on, your bond fund doesn't care that you've never eaten sushi in your life. I'm Tom, and I've spent 10 years running a business surrounded by accountants who taught me that debt is a tool until it becomes a noose. I have multiple hundreds of thousands of dollars invested across index funds and bonds. So when Japan sneezes, my portfolio catches a cold whether I like it or not. Here's what we're doing today. I'm going to explain exactly how Japan built the biggest debt bomb in the developed world, why it's detonating right now, and what happens to your money when a country that owns more US government debt than anyone else on the planet has to hit the sell button. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report so I don't store any of your financial data, link in the description. Think of Japan's economy like a guy at a casino who's been playing the same rigged slot machine for 30 years. In the 80s and 90s, he was winning. The machine paid out. His stack of chips grew. Then the machine stopped paying. But instead of walking away, he kept feeding it money, borrowed money. He told himself the payout was coming. It had to. The math said so. Economists said so. And here's the weird part. For 20 years, it kind of worked because the casino, the Bank of Japan, kept lending him chips at 0% interest. You can stay at a losing table forever if someone keeps handing you free money. But now the casino is cutting him off, and he's sitting there with a mountain of IOUs and no chips left to cash in. That's Japan. And the reason you should care is that this guy didn't just borrow from the casino. He lent money to you, a lot of it, and now he needs it back. Let's start with the numbers, because the numbers are completely insane. Japan's national debt is $10 trillion. Their debt to GDP ratio is 260%. That means Japan owes 2.6 times more than their entire economy produces in a year. To put that in perspective, the US debt to GDP ratio is around 120%, and people freak out about that. Japan is double. Greece, the poster child for European debt crisis, peaked at like 180% before everything exploded. Japan is 60% higher than that, and they've been living at these levels for over a decade. Here's a trick they used. For 30 years, Japan kept interest rates at basically zero, sometimes negative. When you can borrow for free, debt doesn't matter. It's like having a credit card with no interest and no minimum payment. You can keep rolling it over forever. The Japanese government was spending 25% of its budget just servicing debt. But when the interest rate is 0.1%, 25% of your budget can cover a truly stupid amount of borrowing. The math worked until it didn't. Because here's what changed. Inflation. Japan spent 3 decades trying to create inflation. They wanted prices to go up. Sounds insane, right? But when you're stuck in deflation, when prices keep falling, people stop spending. Why buy a car today if it'll be cheaper next year? Businesses stop investing. Wages stagnate. The economy freezes. So Japan printed money. They bought their own bonds. They did everything they could to make prices rise. And nothing worked. For 30 years. Then, 2022 happened. Global inflation spiked. Energy prices exploded. Japan imports 80% of its energy. Suddenly, inflation hit. Not the gentle 2% they wanted. 3%. 4%. For a country that had lived at 0% inflation for a generation, this was a seismic shift, and it broke the whole model. Here's where the casino metaphor comes back. The Bank of Japan had been buying its own government bonds to keep yields low. They own over 50% of all Japanese government debt. They are the market. They were the buyer, the seller, the house, the whole game. But when inflation appeared, they had to stop. You can't print infinite money when prices are rising or you get hyperinflation. So they stopped buying bonds. Then they started selling. Now, Econ 101. When the biggest buyer in a market becomes a seller, prices fall. When bond prices fall, yields rise. Japanese bond yields are spiking. The 30-year bond just hit levels not seen since 1999. And here's the math that should terrify anyone paying attention. When yields go up, the cost of servicing debt goes up. Japan is rolling over $10 trillion in debt. If the average interest rate goes from 0.5% to 2%, that's an extra $150 billion a year in interest payments. Japan's entire annual budget is around $1 trillion. They'd be spending 15% just on new interest costs, on top of the existing 25%. But now you might be thinking, okay, Japan has a debt problem, but that's Japan's problem. Why does this hit the US? Here's why. Japan holds $1.1 trillion in US Treasury bonds. They're the largest foreign holder of American debt, bigger than China. And they didn't buy those bonds because they love America. They bought them because they needed somewhere to park the money they made selling cars and electronics to the world. It was an investment, a safe one. US Treasuries are the safest asset on the planet until they're not safe enough. Here's a scenario. Japan's economy is slowing. Their population is shrinking. The median age is 49. They sell more adult diapers than baby diapers. That's not a joke. That's a real statistic that tells you everything about their future. Fewer workers means less tax revenue. Less revenue means they need to borrow more. But borrowing is getting expensive. So what do? They sell assets. And their biggest asset is US Treasuries. $23 billion in 1 month. That's what they sold recently. Now, $23 billion sounds like a lot, but in the context of a $1.1 trillion position, it's small. It's a test, a trial balloon. But here's how markets work. It's not about the first sale. It's about the signal. When Japan starts selling, other holders notice. China holds $780 billion in US debt. If they see Japan selling, they think, why are they selling? Do they know something we don't? And they start selling. And then you have a feedback loop. More sellers means treasury prices fall. When treasury prices fall, yields rise. When yields rise, mortgage rates rise. Corporate borrowing costs rise. Stock valuations fall because the discount rate for future earnings goes up. Your 401k takes a hit. And it all started because Japan needed to pay its own bills. I want to give you a concrete example. Let's say you have $500,000 in a standard 60-40 portfolio. $300,000 in stocks, $200,000 in bonds. Most bond funds hold a significant chunk of treasuries. If treasury yields spike by 1%, bond prices fall by about 7 to 10% depending on duration. That's $14,000 to $20,000 gone from your bond allocation, the part that was supposed to be safe. And your stock allocation takes a hit too, because higher rates mean lower valuations. A 10% correction wipes out $30,000. You just lost $40,000 to $50,000 in net worth because Japan had to sell bonds to keep their economy afloat. This is where it gets really interesting. Japan is caught in a trap of their own making. They have 3 options, and they're all bad. Option 1, raise interest rates to defend the yen and stop inflation. But that makes their debt unaffordable. They'd blow through their budget on interest payments alone. Option 2, keep rates low and let the yen collapse. But a weak yen makes imports expensive, inflation gets worse, and capital flees the country. Option 3, sell foreign assets like US Treasuries to raise cash and defend the currency. But that crashes the treasury market and pisses off their biggest ally. They're trying option 3 right now, slowly, quietly. But the problem is that slow and quiet doesn't work when the market figures out what you're doing. Bond traders aren't stupid. They see the sales, they see the pattern, and they front run it. They sell before Japan does, which makes the problem worse. It's a reverse bank run. Instead of depositors pulling money out, It's investors pulling money out of treasuries. And the only way to stop a run is to raise rates high enough to make people want to stay. But raising rates is exactly what Japan can't afford. Let me tell you a story. In 2010, Greece had a debt to GDP ratio of 145%. The market decided that was too high. Bond yields spiked. Greece couldn't borrow. They needed a bailout. The European Central Bank stepped in with hundreds of billions in loans. Greece implemented brutal austerity, cut pensions, raised taxes. Unemployment hit 27%. It took a decade to stabilize, and their debt ratio was 145%. Japan is at 260%, and there's no one big enough to bail them out. The US isn't going to bail out Japan. The IMF doesn't have the resources. Japan is on its own. Here's the part that most analysts are missing. Japan's problem isn't just debt. It's demographics. You can grow your way out of debt if your population is young and growing. More workers, more taxpayers, more growth. But Japan's population peaked in 2010. It's been falling ever since. By 2050, they'll lose 25 million people. That's the population of Texas. Gone. And it's not just the total number, it's the age distribution. They have more people over 65 than under 15. The ratio of workers to retirees is collapsing. Each worker has to support more retirees, more healthcare costs, more pensions, less tax revenue per capita. You can't grow an economy with a shrinking workforce, and you can't pay off debt with a shrinking tax base. Japan tried to fix this with immigration, but they're culturally resistant. They let in some foreign workers, but nothing close to what they need to offset the demographic decline. They tried automation. Japan is a leader in robotics. But robots don't pay income tax, and they don't buy consumer goods. So automation helps productivity, but it doesn't solve the fiscal problem. They're stuck. And here's the kicker. Japan isn't unique. China is facing the same demographic cliff. South Korea, Italy, Germany, Spain, the entire developed world is aging. Japan is just 10 years ahead. They're the canary in the coal mine, and the canary is choking. There's another factor nobody talks about: tourism. Japan's tourism revenue collapsed after a Chinese politician made comments about Taiwan that pissed off Beijing. China told its citizens to stop visiting Japan. And Chinese tourists were Japan's biggest source of tourism revenue. I was just in Tokyo, Shibuya, Shinjuku, lots of American tourists. Almost no Chinese. The luxury shopping districts in Ginza were half empty. Hotels were offering discounts. This isn't COVID. This is geopolitics. Japan picked a side in the US-China rivalry, and China retaliated economically. Japan lost billions in revenue. Small businesses are hurting, and it's not coming back until the political situation changes, which could be never. Let's talk about the yen, because the currency side of this is wild. The yen is trading at 156 to 1 against the dollar, multi-decade lows. Why? Interest rate differential. The Federal Reserve has rates at 4.5%. The Bank of Japan has rates at 0.1%. If you're an investor, where do you put your money? In dollars earning 4.5% or yen earning 0? It's not even a choice. Money flows to where it's treated best. So capital leaves Japan. The yen falls. And this creates a vicious cycle. A weak yen makes imports expensive. Japan imports energy and food. Prices rise. Inflation gets worse. The Bank of Japan has to raise rates to stop the bleeding. But raising rates makes the debt unaffordable. They're trapped. Imagine you're a Japanese saver. For 30 years, you kept cash in the bank because prices weren't rising. Holding cash was fine. There was no inflation to erode your purchasing power. Interest rates were 0, but so what? Prices weren't going up either. Now, suddenly, inflation is 3%. Your cash is losing 3% a year in purchasing power. But you can't earn any interest because rates are still near 0. You're getting destroyed. And you don't have the investment culture that Americans have. Most Japanese people don't own stocks. They don't have high-yield savings accounts. They just have cash. And it's evaporating. So what do? Some start buying foreign assets, dollars, euros, anything with a positive real return, which makes the yen fall more, which makes inflation worse. It's a doom loop, and the Bank of Japan can't stop it without crashing the economy. Here's a real scenario. Let's say you're 55 years old, living in Osaka. You have 30 million yen in savings, about $200,000 at current exchange rates. You were planning to retire in 10 years. You saved your whole life. But now inflation is eating your savings. You can't earn interest, and the yen is falling. So you convert half your savings to dollars. You buy US stocks. You're not doing this because you love America. You're doing it because you're trying to survive. And when millions of Japanese savers do the same thing, the yen collapses. And the Japanese government has to intervene. They sell dollars, buy yen to prop up the currency. But those dollars, they came from selling US treasuries. And we're back to the original problem. The Japanese government is playing a game of musical chairs. They're moving money around, trying to plug holes, sell treasuries to get dollars, sell dollars to buy yen, issue new bonds to cover the budget deficit, buy back bonds to keep yields low. It's exhausting. And it only works as long as markets believe they can keep it up. The moment confidence breaks, the whole thing unravels. Now, I know what you're thinking. If this is so obvious, why hasn't it happened yet? Why hasn't Japan collapsed? Because markets can stay irrational longer than you can stay solvent. Japan has been running this playbook for 30 years. Every few years, someone predicts collapse. And it doesn't happen. Why? Because Japan is rich. They have massive foreign exchange reserves, $300 billion in cash. They own $1 trillion in US assets. They have a trade surplus, a highly educated workforce, social stability, no political chaos, low crime. When you have that much wealth and stability, you can get away with a lot of debt. Markets give you the benefit of the doubt. But here's the thing. Benefit of the doubt isn't infinite. It's a function of confidence. And confidence is binary. It's there until it's not. Greece had the benefit of the doubt until 2010. Then it didn't. The shift happened in weeks. Bond yields went from 5% to 15%. Game over. Japan hasn't hit that point yet. But the pieces are in place. Rising yields, a falling currency, a shrinking population, a geopolitical rival cutting off economic ties, and $1 trillion in foreign assets they might have to liquidate. The question isn't if Japan has a problem. The question is when the market decides the problem is unfixable. And when that happens, it's not just Japan that takes the hit. It's every bondholder, every treasury investor, every 60-40 portfolio. Because Japan isn't some small economy. They're the fourth largest in the world, and they own $1 trillion of our debt. Here's what you do with this information. 3 things. 1, if you're heavily weighted in bonds, understand that you're exposed to Japanese policy decisions, whether you realize it or not. Treasury yields are not just a function of US policy. They're a function of who's buying and selling. And Japan is the biggest player. If you're in long duration bonds, consider shortening duration. The longer the duration, the more sensitive you are to rate moves. 2, keep some powder dry. If Japan does start a large-scale liquidation, you'll see volatility. Treasury yields spike. Stocks sell off. That's a buying opportunity if you have cash. The US economy isn't Japan. We have immigration. We have a young workforce. We have growth. A temporary panic because Japan is selling is a gift. 3, diversify out of dollar-only exposure. I'm not saying buy gold or Bitcoin. I'm saying think about real assets, real estate, commodities, businesses that generate cash flow, things that aren't just paper claims on future government promises. Japan's situation is a reminder that no economic model lasts forever. The same country that dominated the global economy in the 80s has spent 35 years trying to escape stagnation. They tried zero rates, negative rates, quantitative easing, helicopter money. Nothing worked because you can't print your way out of a demographic collapse. You can't borrow your way out of a shrinking tax base. The math doesn't work. And at some point, the market figures that out. Lazy investing built more fortune than crypto memes. And lazy investing means understanding that macroeconomic risks aren't abstract. They're real, they're measurable, and they show up in your portfolio whether you're paying attention or not. Japan's debt bomb isn't a theory. It's a $10 trillion reality that's been ticking for 30 years. And the timer just started beeping.